Good afternoon, everybody. My name is Scott Richter, and I'm on the board of the MTA. And I have the pleasure of introducing our speakers for this afternoon, Mr. Paul Desmond and Ms. Tracy Knudsen from Lowry's Research. And today we're going to talk a little bit about the new research they've been doing. We're going to talk a little bit about supply and demand, and we'll talk a little bit about indicators. So let me start out with you, Tracy. How about if I start out with you?
Sure.
And why don't you tell us a little bit about, maybe you can give us a teaser about the research you've been doing recently on the 29 market crash.
Sure. The 1929 market crash, people have studied it for ages, and what we've done at Lowry's was go back and look at the individual trading pages from the Wall Street Journal, going back actually to 1925, and taken that microfilm and recorded all of the stocks trading on each day going back from 1925 through about 1932, so we have a good chunk of history. And we discovered some very interesting things. The advanced decline line showed a clear divergence several years prior to the top in 1929. The percent of stocks making new highs on September 3rd, 1929 was minimal. So you really saw a lot of deterioration in the market prior to that top in September. So we're going to talk about that. And we've also created numerous indicators that are proprietary to Lowry's and some that aren't, using that data from 1929 that we're going to touch on as well.
Okay. Well, Paul, let me flip it over to you now. And Tracy alluded to the AD line, for example, in the 29 crash. And when you think about, or when I think about, when I read research, people typically look at the index by itself. They don't really drill down into some of the substructure. So you guys have actually done that. Tell us a little bit about why that is a unique way to approach the analysis.
Well, one of the things that we discovered was when we looked at the market top in 29, which was September 3rd, people would generally consider that to be the top of the market, which means they'd expect most stocks would be at their peak at that point. What we found was that was not the case at all. There was a huge amount of deterioration well in advance of that major market top. And we wanted to explore more deeply how that weakness developed. And what we've discovered is that the advanced decline line, as we typically use it as a consolidated advanced decline line, has a huge lag to it. It can't indicate any sign of weakness at all until at least 51% of the stocks in that universe have turned negative. And that means that your portfolio has to suffer dramatic damage before the advanced decline line can show the first inkling of a negative message. And so we have been setting out to try to find ways of seeing that deterioration in the early stages before it ever shows up in the advanced decline line. Right now, for example, the advanced decline line is at a new high, and yet 40% of the small caps are already down 20% or more from their highs. So a tremendous amount of deterioration in small caps. 17% of mid caps are down from their highs by 20% or more. So a huge amount of deterioration from a portfolio manager standpoint has already occurred, and the advanced decline line is pointing straight up saying everything's just fine.
And if I could add something
Sure,
to that.
please.
We're also going to look at the 15 major tops from 1929 through 2007, because when we studied that top in 1929, we wanted to see if it was just a one-off event.
And are there similarities?
Oh, there are a lot of similarities. So the market is not, you can't use the Dow or the S&P to mark a specific major market top, because you see such deterioration in every case. I mean, granted, there are some cases when it's worse than others, but say, for example, 2007, I think it was 2000, we had 55% of stocks down 20% or more on the high in January of 2000.
Interesting.
So, we went back and looked at those 15 tops, and we saw a lot of similarities. So you can draw the line through the data, and there are similarities that we need to be aware of. Yes.
Let me flip it to the other side, and it's a little off topic, but Have you done similar work with bottoms, for example?
Well, yeah, we did a study back in 2002 that won the Dow Award that year. And what we found was when you read about market bottoms, you see the writers saying that the bottoms are climactic, or the bottoms have panic selling, or other indications, but those are vague terms, and there's no way to quantify that. So we went back and looked at every major market bottom, not including 29 at that point. We hadn't done that work yet, but every bottom since then, and we found a very consistent pattern of intense selling as you approached the market bottom, in the form of 90% downside days. In other words, 90% of all the price change was on the downside, 90% of all the volume of trading was on the downside. And that told you half the story. It told you that investors are panicking. What it doesn't tell you is whether that panic has been sufficient to drive prices down to a level where the buyers will come running back in to buy up those bargains. So what we found was that at major market bottoms, we constantly see a series of 90% downside days, indicating that sellers are panicking. But the bottom actually comes when you see a 90% upside day follow that 90% downside day quickly. And that indicates that the buyers are anxious to buy back in. If the buyers don't come in, then we assume there will be more panic selling. It will get even worse, and prices will get even lower. And then we wait for the buyers to come back in. And that has done a pretty remarkable job of indicating major market bottoms.
I was just going to say, and because of that panic selling that you see heading into a major low, you don't get the divergence with the advanced decline line that you see at a major market top. You'll see that advanced decline line drop with the market, but then when you get those 90% upside days come in and that strong, enthusiastic buying, you'll see that AD line really take off.
Okay. Let's end up with one other question. I'll ask you about supply and demand, buying and selling pressure, which is something your firm has been known for a long, long time. Do you have any recent insights with respect to those sort of indicators and that you can share with us right now, or anything new that you developed that embellishes supply and demand analysis?
What we're seeing right now with our buying power and selling pressure is a very healthy marketplace. We did a study of major market bottoms and our buying power and selling pressure indices, and heading into major market tops. Heading into major market tops, you will see selling pressure start to increase, which reflects increased distribution as you're heading into a top. And we're not seeing that right now. And typically that will be a well-established uptrend in selling pressure to reflect that distribution.
So it's consistent.
But right now, essentially, we're seeing a sideways selling pressure. So you are seeing increased selling, but not in any type of accelerated rate. And that's being met with strong demand. So you're not seeing a deterioration in demand. So as it stands right now, with the trends of demand and supply, we're still in a healthy bull market.
So a little bit of a warning flag with respect to the divergence in the AD, but buying and selling pressure looks reasonably healthy for now.
We're in the autumn of the stock market, and what we're seeing is individual stocks falling off the trees, like the leaves fall off the trees in autumn. And but the process of deterioration has not gotten to the point of setting off the alarm bells yet.
Not yet.
Based on past experience, we'd say that there's probably another 6 to 9 months of market advance in terms of the big cap indexes. The S&P 500 index will probably keep making new highs for maybe another 6 to 9 months.
Great.
But there's a bear market out there creeping around, scouting it out.
Okay, well, I'm sure you'll apprise us of that when that time comes, and I just want to thank you so much for being here at the symposium and for speaking today.
It's our pleasure.
Thank you.